We've done two media files already for this class. The first one you'll recall is on developing a capital program, how to think of it in planning and strategic terms. And then the second was on how to pay for it. And you'll recall the ending of this second media file was really about the necessity of, the desirability of, in most instances, debt. So the third media file, which is this one, we're going to be spending more time talking in detail about debt. A lot of this is going to be a supplement to the reading, which provides the basics for in detail for some of the issues about how debt is used in higher education. And most of the talking today is going to be done by a fellow named Joe Bosch, who was interviewed by Professor Buxbaum recently, talking about debt from the investment banking perspective. Usually that means the issuance of tax-exempt bonds for colleges, and Joe assists as a finance professional in that process. So he has a long experience working with higher education institutions with respect to debt and issuing bonds, which is a form of incurring debt by colleges and universities. We'll let Joe do the talking. He'll start with a brief introduction, and I'll do some of the intros and follow-ups on some of the other questions and answers that come up during the course of his talk.
Hi, I'm Howard Buxbaum, and I'm here today with Joe Bosch. Joe is a managing director at Janney & Company, and today we're going to be talking about debt financing and debt management. And Joe, thank you very much for being with us today.
My pleasure, Howard.
Joe, could you tell us a little bit about what debt is, what the various types of debt are, what they're used for?
I'll do my best. In the most literal terms, debt is borrowing of capital by an entity in order to finance either operations or more customarily capital projects that either cannot be financed from operations or can be, but over a long period of time.
Note a couple things here. Joe says that debt is used for both operations and capital. I had mentioned earlier this is part of a capital strategy. Just to point out, most of the time it's about capital. Occasionally, colleges will borrow short-term because they don't have enough money to get through a given fiscal year. But long-term financing is for long-term assets, so it's mostly capital. Note also, he does suggest what I was saying in the earlier media file, that debt is often used when you cannot fund something of the scale that you need to fund from operations. Now he will turn to the purposes that debt is put to within higher ed.
So Joe, how does this fit in? I know you do a lot of work with colleges and universities. How does this fit into their scheme? In other words, from a real life perspective, at a very high level, how are they using debt? How does that fit into our overall topic of financing of higher education?
Well, an essential component of the higher education experience historically has been the ability to go to a college campus where certain amenities exist. And that's not only classrooms, laboratories, research facilities, but also increasingly in importance, life care centers, which include not only workout and recreational facilities, but also dining courts as opposed to cafeterias. In addition, dormitories. In addition, sports facilities. In other words, outside of the online learning experience, college is in fact an experience. It's not simply a academic endeavor. It's a life immersion experience that can take anywhere from 4 to 6 years. So colleges need to provide for the development of these modern facilities and also to upkeep those facilities once they're in place. A portion of that can be financed on an ongoing basis out of operations, but importantly, many of these facilities are multi-generational in nature, and decisions are made that rather than finance out of operations or certainly out of endowment, it's more appropriate to finance these things on a longer-term basis so that the various generations involved in their benefit will be involved in their repayment.
My takeaway here it's listen to what he's saying about the range of things that are actually being financed on campus now. It is in keeping with the shift, not away from academics in colleges, but colleges are very much about lifestyle nowadays and lifestyle amenities. So when Joe, who's an actual banker, is out there doing financings, he's pointing out, yeah, we're doing some classrooms here and we're doing some classrooms there, but we're doing a lot of stuff in the lifestyle area. We're doing recreation, we're doing food courts, we're doing new kinds of dormitories in residence life, we're doing sports facilities. So what he's kind of pointing out here is goes kind of without saying, is that the kind of financing that's taking place for capital is not only about academics, but it is in fact increasingly being overshadowed by non-academic financings.
Joe, one of the things that's available to, as you know, for not-for-profit or government entities is the ability to borrow on a tax-exempt basis. You know, probably most people have heard about tax-exempt bonds. Can you talk about how that comes about and what the impact is on the interest rates or the ability to borrow of not-for-profit and government-based colleges and universities?
Sure. In its simplest form, the federal government determined that they were comfortable providing a subsidy for states, municipalities, governmental entities, and then 501c3, which refers to a arcane part of the U.S. tax code, corporations, which are also generally known as not-for-profits. Further, they're non-religious not-for-profits that conform with certain rules, regulations, and requirements of the Internal Revenue Service. So for states and local governments and qualified 501c3s, which would include public hospitals, colleges and universities, cultural organizations, human service providers, the federal government determined that debt which is sold on behalf of those entities, the interest on that debt can be exempted from federal taxation, and then states and cities have also made decisions historically that they will exempt that debt from state and local taxation. So, for example, for a resident in the city of New York, there is a real economic advantage to purchasing tax-exempt bonds as opposed to taxable bonds because the after-tax yield to the investor is substantially higher than most normal taxable investments. And this was set up purposefully to provide a subsidy for the entities involved.
That was Joe on tax-exempt bonds and tax-exempt finance. It should be relatively clear, particularly if you supplement it with the reading this week, which goes into more detail about it. The essential point to remember here is why institutions like tax-exempt debt rather than what's called taxable debt. With tax-exempt debt, because of the way the law works, when the repayment is made to the person who is the originally made the loan, that is to say the bondholder, they get principal and interest payments back. The interest portion in a tax-exempt situation is not subject to taxation, whereas ordinarily if you get an interest payment from a company, let's say, that's included in your income and you're taxed on it at whatever rate you're taxed, 28, 30, 32%, whatever. So what that means is, because the holder of the debt, the one who gets repayment, doesn't have to pay taxes on the interest from the repayment from the college, they're willing to settle for a lower interest rate because they're getting a portion of their return, if you will, by virtue of the fact that they don't have to pay taxes that they otherwise would have had to pay. So that means that in a taxable debt might be issued at 4%, tax-exempt debt might be issued at 2%. There's going to be a spread between taxable and tax-exempt debt, which usually, almost always, is lower in any given market or any given set of credit conditions for tax-exempt rather than taxable. So that's what he's trying to get at here. He will now turn to the question of underwriting and the role of what an underwriter or an investment banker does when they actually work with the college and university to structure and to underwrite and to bring to market a bond issue.
Those agencies actually issued the bonds
That's correct.
on behalf of a college. So if you could return to your discussion about
Sure.
underwriting,
Let
because
me-
I think that's
Let me describe.
perhaps
the
one of the most
process,
interesting
yeah.
aspects of this from my perspective.
So again, in order to avail oneself of the benefit of tax-exempt financing, most colleges and universities could not simply issue the debt themselves. They have to work with a cast of characters. One important component of that cast is the issuer, which we've just been speaking about. And the issuer is governed by certain policies which it adopts, certain laws which are promulgated by a state legislature, and then probably most importantly, by requirements from the Internal Revenue Service, which say you must do the following things in order for this issue, for interest on these bonds to be qualified for federal tax exemption. And so there's an application process, there's a hearing process, public notification, etc. And there is a time factor associated with that. So it's not like a college vice president wakes up one morning and says, I need $20 million for a new dorm, let's close tomorrow. Unfortunately, there's a long, defined as a 3 to 4 month period that he needs to work with a group of actors. A second important actor in that constellation is what's called a bond counsel. And a bond counsel is a law firm that has experience in tax law such that it has gotten itself listed in what we call the Red Book. It's generally regarded as an expert on tax law and goes through a checklist which is quite extensive and again is usually in response to IRS requirements to make sure that the issuance process, the borrower itself, that all the terms and conditions required to have the interest on the bonds be exempt from federal taxation are observed. And that actor is called the bond counsel. Since this is a process which involves a lot of counsel, the borrower would probably have its own counsel.
Of course.
In addition, there is an entity, which is usually the role that we play, which if these bonds are going to be issued to the public, meaning that we're going to sell bonds out to the public, then an entity like Janney would serve as the underwriter in the process. And the underwriter works with the client throughout the process to define the terms and conditions under which these bonds are going to be issued, how long they're going to be outstanding, what the security elements of the bond issue might be. We also work with another important actor in a public sale, and that is actor or actors, the rating agencies. And we then perform a very vital function, and that is the issuer will issue the bonds, but they never put up any money to facilitate the sale. So someone has to. In the first instance, it's the underwriter. The underwriter actually purchases the bonds from the issuer and then is enabled to sell those bonds to the investing public within certain very tightly defined terms and criterion as to what prices.
But if I'm correct, though, Joe, isn't there a period of time where let's say someone's borrowing $20 million, where you've essentially laid out $20 million. In other words, I'm a college or university. We have a closing. We signed all the legal documents. You've now put up the $20 million. You make that money available to the college or university that I'm representing. And then, if the way I understand it is, you then sell the bonds
We attempt to
to
sell
the public in order to recoup the 20 million plus whatever profit or overhead that whatever margin you need as a private firm.
Again,
Does that
within
sound right?
very tightly defined
Right.
regulatory boundaries. That's exactly right. And it is during that period of underwriting when we've purchased the bonds but do not have them sold, and the bond issue itself is really not closed, that we are at risk. Our capital is at risk, and for that we obviously look to be compensated, and that's usually an underwriter. The convention in this process has been that underwriter gets compensated at the conclusion of the process. That is, when there is a closing
Right.
on the bond issue, they get their money back if they've had a successful sale.
Remember earlier how we said debt can be a problem? You can issue too much of it. You may not be able to pay it back. Now Joe and Howard will turn to that question. Howard will ask about how institutions deal with this issue and what safeguards are out there. Is there anybody that's looking, that's sort of advising people? And this is where Joe talks about how his firm as an underwriter will help issuers think about how much debt is too much and how the rating agencies also think about that and what data that they use to make that decision.
Thanks, Joe. I want to shift gears a little bit, and that is, if you think about your own situation, personal situation, most people try to figure out how much money they could borrow. If you go to a bank, sometimes they'll tell you, saying, well, Mr. Buxbaum, we'd like to lend you money for this house, but we think it's too much. We're not willing to lend you $500,000 for this house. We don't think you have the ability to repay that. If you expand that to larger institutions such as colleges, universities, and you touched on this before, how do institutions determine what the right amount of debt might be? In other words, is it too much? Is it too little? I think we all intuitively know that too much debt is probably not good. But it sounds like you've done some work in helping colleges and universities figure out what that should be. Can you talk about that for a little bit?
Certainly, and you're quite correct. That decisional calculus is one that institutions have to go through, should go through periodically, in my opinion, whether they want to borrow or not, just as individuals should. Moody's, Standard & Poor's, Fitch, the rating agencies, have developed a series of ratios which are very instructive in this regard, and they use those ratios to calculate ranges, and then they assign credit worthiness to those ranges, and they call them ratings. We use that same kind of technology with some modifications to help our clients think about their current situation, and if they're considering taking on new debt, what amount should they consider? What amount can they afford? What amount is defensible? What amount would not require them to radically alter operations in order to continue to pay for their debt on time when required? And so we use the ratios that are time-tested by the rating agencies, but we use them in a little bit of a different way, in that we basically work with 6 or 7 established ratios which deal with different components of the credit character of the borrower. Liquidity being very high on the list. One of the things that one adage that people return to with vigor, and in the face of the last fiscal crisis, was that cash is king and liquidity is really important. And so we have always believed that.
So when you say liquidity, that means the amount of cash you have readily available to pay bills.
That's correct.
Okay.
And more broadly speaking, the amount of unrestricted net assets that the institution has. And that is a baseline in terms of calculating what your debt capacity is going to be or may be. We also look at strength of operations. We also look at size of endowment. We also do a series of other calculations. And we take ranges based on those, what those ratios come out to be, and we give our clients, instead of a number, we give them a range, a low and high. And usually somewhere in between is where everybody winds up being comfortable. And that is very defensible from a ratio analysis perspective.
Finally, Joe and Howard turn to an important question of what are called covenants. When you issue bonds or engage in any kind of financial transaction like a loan with a bank or a bond that's underwritten and sold to the public, you typically have within the deal something that are called covenants. meaning the things that when you take that loan down and get that money, that you're making a promise of things that you will do or will not do over the course of time that the bond or the loan is in place. These are important guarantees for the lender or the people that are providing the money that you will actually behave and do the right thing during the time that the bonds are outstanding.
In other words, can you explain, can you let us know what is, a bond covenant? What is a bond covenant, and why is that important?
Okay, in its purest form, a bond covenant is a legally binding promise made by the borrower to the lender. Remember, the lender could be 100 individuals that buy bonds, or it could be a bank that's buying one bond. So there is this stage, when I say create a bond issue, there is this stage where you actually generate a series of documents which detail the legal underpinning of the bond issue itself. Covenants, again, are promises by the borrower to do or to maintain certain things. For example, the liquidity, again, is a big issue to lenders. Having been through a negative experience not too long ago, where liquidity became a very important factor. So most lenders want to see that the borrower maintains certain liquid reserves in order for them to lend them this money. And so the borrower would agree to do that, and that's usually expressed in the form of a reserve maintenance covenant or some other ratio which gets at the liquidity issue. A covenant may also be if you're borrowing on one of these cash flow financings that I spoke about. You're borrowing, you agree to set rents, for example, in your residence halls at a level which would produce the coverage that is required. You may also have to promise not to take on additional parity debt unless and until you can meet certain debt service coverage ratios. That's fairly common in today's world. And the notion there is pretty simple. The lender today doesn't want you to go out tomorrow and borrow another $100 million on the same terms and conditions if you can find another lender to do that, because that will erode the security that he has in your loan. So there are those kinds of things. And it is a dance between the borrower and the lender, usually orchestrated by an intermediary, me, that try to minimize the number of covenants that the borrower has to agree to, because candidly at some point it gets too unwieldy, but gives the lender enough security so that they feel comfortable lending at the rate that you want them to lend at.